Excellencies, ladies and gentlemen, welcome back. I hope you all had a chance to visit the FinTech exhibition, grab some coffee. We want to get started with the first session now of the day, entitled Global Economy in Retrospect, Emerging Trends and Challenges. I don't want to steal anyone's thunder here, so I won't say much at this point. Suffice to say, we've got an awfully large number of variables that everyone needs to juggle right now, and how authorities manage those variables, of course, will have a huge bearing on confidence levels going forward. One quick point before we start. This is about the voting. I'd like to mention we've got a survey question or two associated with each session to answer those, and the moderator will put those up on the screen. Please visit the Slido/CBK, which is sli.do/CBK. Select the poll tab from the top of the screen, then select one of the options and submit it. It's pretty straightforward. I'm sure you've used it before. The answers are going to be shared during the session so that our panelists can react to those answers. You can also use this app to submit your questions for the panelists. As I said before, we've got some fantastic speakers today, so please do make the most of that and submit your questions to them. You can do that anonymously, or you can put your name on that. Let's get to the panel. Please welcome our moderator for the first session, Ms. Susannah Streeter. Susannah is anchor for World Business Report at the BBC. And our panelists, and I'll do this in order: His Excellency Dr. Ahmed Al-Kholifey, Governor of the Saudi Arabian Monetary Authority. His Excellency Dr. Ziad Fariz, Governor, Central Bank of Jordan. Dr. Garbis Iradian, Chief Economist, the MENA region for IIF. Mr. Henk Hoogendoorn, Managing Director, Financial Sector, the Qatar Financial Center Authority. And at the end is Mr. Omar Alghanim, Chairman of Gulf Bank. Susannah, let me hand it over to you.
Thank you very much, Axel. And I'm really delighted to be here at this really time for the global economy. Of course, the global economy is now facing a number of clear and present dangers. We have the rising trade tensions, geopolitical crises, of course, and the volatility in currency and commodity markets. Add to that 10 years of unconventional monetary policy, including those ultra-low interest rates, which has led to that huge stockpile of global debt, totaling $246 trillion. As His Excellency the Governor was pointing out a little earlier, that's around 320% of global GDP. Now, should that issue alone be a real threat to the global economy? That's just one of the questions we're going to be debating on this panel, and I'm really delighted to be joined with such a diverse and distinguished panel of business leaders from the industry. It's really great to have you here. So, we're going to be discussing the threats to the global economy, the tools that are still available to mitigate those threats, and also really how this impacts the banking sector as a whole. But before we start, I do want to reiterate what Axel was saying, that we really want to make this debate as interactive as possible. So please, via Slido, do send us your questions. But before you do, I actually want to ask you all a question. I'd like you to participate in a poll and find out, just take the temperature and your assessment of the global economy and the risks that are presented at this moment in time. So on Slido, I would like you to answer this question, and there are 4 answers you can choose from. What do you think poses the most risk to stability of the global economy? The first answer, rising debt levels. Second, trade disputes. Third, geopolitical tensions. And the fourth, unconventional monetary policies. So if you could vote and take part in that poll, and then a little bit later during this panel, I'll bring you the results and find out what you're all thinking about the present threats at this moment in time. But let's kick off the debate and the discussion now. And I would like to ask Your Excellency, first of all, Dr. Ahmed, what do you assess as the greatest risk at this moment in time to stability for the global economy?
Well, first of all, thank you for the invitation, and I thank the Central Bank of Kuwait, and particularly Dr. Mohammed Al-Hashil, the Governor, for inviting me to participate today. I would assume geopolitical risks are the highest. Unfortunately, the political side began to intervene in the economic side, and that has impacted really the scene. And we see the trade tension is one good example. We see also some interference in the central bank business, while we have gained very good independence when it comes to the central banks. This has also impacted the general confidence and the investments from the private sector. In addition to that, the impact on the financial market, the risk of taking place right now as we see it, and probably Dr. Mohammed has shown the indices recently. This has really blurred the whole scene when it comes to the financial market and the global economic picture. The challenge ahead of us is whether we have room to maneuver or not. Monetary policy has done a great job aftermath the recent global crisis. The same thing to some extent the fiscal policy. Yes, structural changes have been lagging behind, which really we need to do more. But all in all, there was very good collective action, particularly from the G20, to address all these challenges. Unfortunately, with the recent changes in the geopolitics, things are changing, and it looks like we are going behind right now. Again, the challenge ahead of us is whether we have room to maneuver, central banks and the fiscal side as well.
Absolutely. So it's the room to maneuver, which is absolutely key. Your Excellency, Dr. Fariz, do you think that central banks do have enough room to maneuver? Because we've had this decade of unconventional monetary policy. And are you concerned about rising global debt levels?
About rising what?
Global debt levels. And
debt.
Does that concern you, or do you think the fact that perhaps central banks have less room to maneuver, given the fact that they have been employing these unconventional monetary policies for so long?
Well, let me first thank the Central Bank of Kuwait for holding this important conference and inviting us to participate. It's very important at this point in time where the world economy is, well, at a turning point, actually. And I think, I hope this will help us understand the situation further. Definitely, indeed, the debt question is a big question, and it's a challenging. As it was described this morning by the governor of Kuwait, the trend is, the outstanding is huge, and the trend is dangerous. If the debt is growing at a faster rate than the growth of the economy, of the world economy, then we're heading towards further problem. That means debt is sustainable. Debt is going to threaten financial stability. That is threaten the ability of people to have a better living, actually, talking about human being. And this will complicate life. I think the question remains that the situation now is the resultant of lack of proper policies, lack of reform in most of the countries, huge deficits from the world economy at large, particularly in developed countries, and the problem is worse in developing countries where the domestic revenues is still small. So we have a lot to do from a fiscal point of view, from a conventional wisdom point of view, to control the growth of debt and stimulate the economy. Here is another formula, another equation, which is difficult and subject to so many arguments. And we are witnessing today a confusion worldwide. I'm talking about not only Brexit, the trade war, the currency war, which will impact the whole world and will deteriorate the trade and eventually the growth. And here, the central bank. I tell you what, we're fed up with the central banks, dealing with problems created by others. So, and formulating, innovating policies to solve the problem. But the real fact, we need to face governments should deal with the structural problem in their expenditure and create the financial stability and sustainability.
Let me pick you up there and introduce Henk, because do you agree with that assessment, that is a really crucial issue that governments have got to get to grips with, their spending, and reduce this level of debt around the world? Or do you think perhaps that this issue has been overblown?
Well, actually, I think it's a great risk in terms of the global debt, and everybody expecting the next crisis to come from that. But maybe there's another source. What I found surprising is that a country, you know, the strongest economy in the world, is increasing its debt levels by a higher percentage than the rest of OECD. I think that's alarming, and I think that should be controlled, you know, by the institutions in that country. Because it has an effect on the whole world. And I think, you know, the gentlemen have rightly pointed out what the risks are. And I don't think we should sit idle, you know. How is it possible, and we will probably discuss that, that a regulator in that country reduces, you know, the interest while, you know, we don't need further economic stimulus in that country. So it's better to prepare ourselves. But let's not be afraid as well, because crisis, we also need crisis to go to the next level, and we need some correction from time to time, and we need to probably correct a few things that have gone out of direction. And
what about the effect of ultra-low interest rates? Because that does, in many ways, offer a lot more room for maneuver.
Exactly, and I'm pretty sure that I'm not a regulator, but the regulator, typically the monetary tools that they have, you know, is work with the interest rates, and they are already quite low. So how far can you go? Negative, I think, is a negative yield is a horrible scenario, because people cannot, you know, save and save for their pensions and everything. So then the governments with their fiscal solutions and tools, they should work in tandem with the regulators. And in this part of the world, we discussed that, you know, the fiscal tools are limited. So it's a tight line, and I think regulators should act stronger and give a strong message to governments, because regulators and governors are there, you know, are wise men, professional people who have been there for a long time, and politicians come and go. I think this is the time for regulators to stand up and say, you know, this is what we think we should do to prepare ourselves for the next crisis.
Okay, Henk, so the role for regulators, the role for governments. Let's look at the role for politicians. For example, the rising trade disputes between the US and China. Is that perhaps one of the areas that could kick off the next financial crisis? Let me get the view of Garbis. To what extent do you think that these rising trade tensions around the world pose a fundamental risk to the stability of the global economy?
If we take it from the US economy, our investigation shows that the impact has been limited. Yes, the manufacturing sector in the United States is in recession. However, historically, it showed that recession in manufacturing is not a good predictor of overall recession. It's the usual up and down in the manufacturing sector, which is due to the overhang of inventory levels. So when inventory goes up and down, it will impact the manufacturing sector. So far, the trade tensions had limited impact on the US economy. However, the impact of the trade sanction is more on other economies in Europe, in Germany, for example, countries which have trade to GDP ratio much higher. I take it Italy, Germany, and some of the Southeast Asian countries, where you have seen that exports both in nominal and volume terms, declined. Even investment to GDP ratio declined. So there is an impact, but for the US, it's limited. I would like to add a little bit on the debt issue, if you allow me. I don't agree fully what my colleague said about the level of global debt and the threats from the global debt. If we look the decomposition of global debt, where the rise has been, it has mainly been in non-financial corporate debt. But if you look at the government debt to GDP ratio, it has been stable. And we have to look at case by case, different countries, they have different levels. And also, we are in an environment where interest rates are very low, which implies that the debt service is manageable. The debt service on the debt is on average less than 10% of disposable income. So it's not that serious, and this implies that there is some scope for fiscal stimulus in some countries, like in Germany, where they had relatively low government debt, about 50% of GDP, and they have been running large surpluses, both on the current account and the fiscal balance, large surplus.
Let me bring in Dr. Ahmed. I know you wanted to make a point about what was just said.
No, I just wanted to comment about the trade tension. There is general dissatisfaction with the multilateral trading system as we see it today. And worse, there is disagreement on how to fix the WTO. So the problem is not just the trade tension taking place right now, but again, we are going back. I mean, with the inward looking, like we are withdrawing from the globalization and the benefits of globalization that we have seen in the last few years. What would be the future? Because we are thinking about there is a disruption in the supply chain, which again brought up very good gains for the globe. In addition to that, there will be more disputes when it comes to the intellectual property rights and the technology transfer as well, which is again not beneficial to the rest of the world.
Let me bring in Omar now, because I know that you are concerned about the rise in anti-globalization sentiment as well. To what extent, along with Dr. Ahmed, do you think it could really pose a significant threat? Because we are seeing this sentiment pop up in so many different countries around the world now.
Yeah, I agree with what His Excellency was saying about globalization and the fact that globalization over the last 20, 30 years has brought the planet out of poverty into economic growth, into a level that we've never seen before. But the interconnected nature of globalization, when you have countries that take nationalistic stances, the ability to quantify the cost of those nationalistic stances is really hard, because you have a politician in country XYZ who says, we should have this factory here again. And then the supply chain for the other factory where the real comparative advantage is no longer gets built. But not only that, you have a bunch of people who are trained up to be factory workers again when they should be service workers. And the follow-on effect, the laggard effect for that is really large. And I think we in this room don't have the effect to change those types of policies, but I think what our role perhaps could be is to say, well, there's an iceberg, and the risk is bigger than what we see just above the water, and there's bigger risk below it, and our ability to quantify what that risk is difficult because of that very interconnected nature of it. And just to reflect on the 246 million, and I think you touched on this, Your Excellency, is, 15 to 20% of that has a negative yield now. And the fact that you're paying somebody to take your money and store it, there's a storage cost to taking your money, there's a supply-demand gap between debt and cash, right? So as we have this very complex system, but fundamentally, we have too much supply of cash and not enough demand for debt. And the underlying issue there is that there's not enough economic growth, whether private sector or through elected officials, infrastructure or other projects, in order to get a yield off of the debt or the demand on the debt up.
Do you think, Henk, let me bring you in here, that there is, of course, this real concern about the impact of trade tensions, but will it result perhaps in simply different trade partnerships springing up?
Yeah, so it's, you know, you cannot stop trade in the world, you know. We all are here because there has always been trade. It's like water, you know, you cannot, it will always find its flow. So the fact that we have a trade war here means that, you know, everybody's scared. But, you know, you see new things popping up. And for instance, Europe and some of the Latin American countries in Mercosur, they are basically working together on a trade agreement. The good thing, this is about $42 billion involved. But the good thing about this, you know, these new trade blocks, and China will do the same, will lead towards more pressure on the dollar, because I think, you know, the dollar will be dominant for the next 5 years, but there is pressure. And I hope that trade will be settled in other currencies as well. Euro, RMB, maybe baskets of other currencies, maybe some digital currencies coming up. Because that needs to happen, you know. Ultimately, if you look at it, you know, maybe the US dollar was the biggest cryptocurrency or casino coin ever. You know, it has brought us a lot, but it's time to sort of reset.
Let's talk about the tools that are still at central banks at disposal in dealing with such threats. Dr. Fariz, Your Excellency, you said you were fed up with actually having to deal with effectively the mess that politicians are making and you having to clear it up. But do you feel that you still, as a central banker, have enough tools at your disposal to use in the event of a global downturn?
Well, I'm sure we'll find a way, but central banking, I mean, let's go back when the central bank intervened in the market after the 2008 crisis. The intervention was assumed to be temporary, and apparently it's become essential and permanent. So I think worldwide, I think there's still room for the central bank to continue its intervention through probably further interest rate reduction, injection liquidity in the market again to stimulate. But there is a limit. I'm sure without, as I said at the very beginning, other policies to be adopted worldwide and on national level to adjust the situation in terms of imbalances that exist, the central bank impact in terms of stimulus of the economy, stimulating the economy, is going to be limited. Therefore, there is a need for coherent policies, some sort of consistency between trade policies, central bank, fiscal policy that will help out going out of this situation.
Yes, Your Excellency.
Yeah, just a quick comment about the monetary policy and the tools. In fact, the monetary policy has done the heavy lifting after the crisis, and I think they will be out of tools soon enough with the cumulative debt we see and with the structural problems taking place. What I think is that really we need to think about structural changes We have long-term problems. We need to address them with long-term solution. Unfortunately, the structural reforms have not taken place in a lot of parts of the world. We have done, as I mentioned earlier, a good job when it comes to monetary policy, the same thing for fiscal, but not for structural changes. If the risk of that is taking place right now continues, then we'll have a problem with the liquidity taking place here or there. And then some of the countries who are heavily indebted, they might not be able to reach and tap the market, but also they will find it very difficult to pay off their debt.
You talk about structural changes needed. Omar, what role should the private sector play in this as well, not just policymakers?
Well, I think in our part of the world, in the Gulf, we have the second youngest population after sub-Saharan Africa. We have this population that some of us look at and say, is it a liability or is it an asset? And I think a lot of it's about vantage point. And the vantage point one takes a look at it. After looking at the fintech booths down today, after my experience in working with setting up in Jazz, where we train up 300,000 youth in 14 different countries across the Middle East. And how do we do that? We bring in volunteers from the private sector who teach critical thinking skills to young people. That results in a competition in each country and then culminates in a regional competition and lots of people going out and starting up their own ideas. And I think when we look at what is that asset? The asset's not an asset that comes and works solely in the government or in the private sector, but become disruptors, solve problems. That's how the greatest value has been created around the globe over the last 30 years. Critical thinkers who see pinch points, who see problems, and solve them with an entrepreneurial spirit. And I think that we have an abundance of that asset here in this region. I think the private sector has a role in getting involved and teaching those young people those skills. Because as we diversify, one of the ways we become sustainable is diversifying our economy away from oil. And the way we diversify our economy away from oil is by looking at the asset of our youth and having them go out there and innovate and get our economy to be more diversified. And I think sometimes things can just be a vantage point, rather than thinking of this as a burden on society, we think of this as an asset that society has. And I'm very optimistic about that. I'm very optimistic after walking around the booth downstairs and seeing some of those ideas that the young people had and over the different ideas that have been coming up. I really think that we have a lot of potential in this region. Also with our women. And in the kingdom, you have women entering the workforce. That's half of the workforce entering in, the multiplier effect of that for the GCC. I think that from that end, from our human capital perspective, I think we have a lot of upside there and a lot more to grow on.
Because up to this present time, do you think this kind of drive for financial stability has meant that, say, for example, financial inclusion, social policy has been neglected to some extent, Your Excellency?
If I may, I think in the G20, they have came up with one of the policies that is sustainable and the sustainable growth. That's sustainable. But recently, they thought about inclusive growth just a couple of years ago. So we need inclusion in all parts, in health, education, the growth, financial inclusion, etc. So you put the right word, which is inclusion.
Inclusion. Let me bring in some of the questions that you've been sending through now. Naveen Rajania said, will the trade dispute escalating between the US and China, with it, is there an opportunity for Middle East economies and other emerging economies to benefit from this trade war? Garbis, what do you make of that? What do you think? Do you think actually that because of the US-China trade war, countries in the Middle East and other emerging economies could benefit?
I think in the case of the Middle East, there will be limited impact because most of the Middle Eastern countries are not as much integrated in the global economy. If we take oil exporters, most of the export is oil, almost 80%. Very few countries in the Middle East, I would say Morocco, Egypt, and to some extent maybe Jordan could be impacted by the trade wars. But the main threat for the Middle East, I would say, is the oil prices, because if oil prices stay at low levels, much lower than $60, both oil exporters will be impacted negatively and the oil importers, because oil importers' economy depend highly on the oil exporters in the form of investment, remittances, etc. But overall, I would say the Middle East will be less impacted by the trade war.
What about other, go ahead.
Yeah, but I thought you were thinking about the benefits of the Middle East economies. They have great potentials, well-educated people, and they have plenty of resources. But we need to reap up the benefits here, where we need to jump in and be part of the new supply chain.
In what way? What kind of benefits could you?
Well, again, since we have the good number of people and the well-educated, we need really to lift up some of the industries that we are lagging behind. It will take a while again, because we need to do some of the structural changes, particularly infrastructure.
So that was a point that His Excellency the Governor was making in the keynote speech, all about maximizing talent. I think Henk wants to come in here.
I would like to add on the China angle, because the Belt and Road Initiative of that country, you know, is improving the trade. I think the Middle East in general, I think, has a key position between Asia and Africa. And all of the GCC countries are competing for a position in that. We all have very good airlines, very well connected. Yes, we have cheap oil, and I think, you know, we can benefit as this region from those developments. And now the US and China are not that friendly anymore. I think this is the chance for this region to benefit even more. And I would encourage governments to reach out to that part of the world and to play a key role into those flows that go into Africa, because Africa, I think, is the next continent that needs to be developed, and it would be a missed opportunity if we don't grab it.
Omar.
Yeah, I just see it as a net loss for everybody. I think when you have a trade war between the US and China, everybody loses. Because we provide the downstream petrochemicals for China, for the plastics inputs. That goes down. Oil prices go down because the global economy slows down. And as the global economy slows down, we all lose. So I think isolating things like that and saying, how do we benefit out of this is a bit myopic. And I think as one takes a step back, in this interconnected world, we're all losers.
Now I want to bring in another question which has come in from the audience. Omar has asked, we've been witnessing recently US monetary policy via presidential tweets. Is the era of independent central banks coming to an end? Now this is a subject that I wanted to get into, one which we have been discussing prior to this panel. So Henk, give me your view on this. Just how important is it that central banks stay independent? Because we've seen, not just in the US, but in other countries as well, that there has been pressure from politicians on central bankers to make decisions which might be good for the short term, but not necessarily for the longer term.
Yeah, I think it's a very actual topic. If we look at the Twitter of the Mr. President, you know, we see these blunt attacks on regulators every day, and I think it's a shame in terms of the way it's happening. I think this is not the way you deal with people. This is not the first time I think there are pressure on regulators in general. It happened in the 60s and 70s of the last century, where inflation was too high and there was a lot of political pressure to do something. But then, in my view, that's different, because you would expect from regulators to safeguard, you know, the economic stability, make sure that the inflation is controllable and everything, and that there's enough work for everybody. But I think, you know, we have seen in the US, but also in Turkey and India, where basically there's a lot of pressure on the regulators, and even the governors of the central bank, you know, step down. I think it's not acceptable because the fear is if the political pressure politician would take over, I think that would leave us in a worse position. The question is, would the Fed have, decreased the interest rate if there wasn't pressure? I don't know. We all guess, so we don't know what the reason is. Why would you do this? Why would you limit your tools for when the going gets tough? So I think this pressure is not good. Regulators should be independent and should maybe speak out a bit stronger. Explain to the audience what you're doing. You're safeguarding the money for your pension of the people of the country that you live in.
Garbis,
it's for the future.
Yeah, sorry to interrupt, Henk. I know you're quite keen to talk about this subject. I mean, it's the second time since June that the rate has decreased in the United States, and there are projections for another decrease at the end of the year. Do you, like Henk, believe that really does limit the options for the US Federal Reserve?
Definitely. I mean, the rate cut by 50 basis points this year was premature. Because most of the indicators in the US show that the economy is still strong. The first half registered 2.5 growth rate. This third quarter most likely will be around 2, and the last quarter around 1.8. So this is based on the leading indicators, which is a forward-looking, where it shows that the economy is still strong, particularly private consumption. Now, of course, the Fed helped in its lowering the interest rate. They were concerned a little bit about the slowdown in the global economy, the impact of the trade tensions, and to some extent the stock market. I mean, the Standard & Poor's peaked recently partly because of the lower interest rates. However, I mean, when you're starting from interest rate which is 2.5 and you're lowering already, what if you enter the recession? You will not have enough room of maneuver to reduce interest rate in order to fight the recession. In previous business cycles, recessions, the Fed had about 4 to 5 percentage points to work with. Now they have only 2%, which means that there is a risk that when we enter a recession, that eventually the interest rate will be negative, as it is the case in Japan and in Europe. So, and this could be very risky because you could go to a vicious cycle, low interest rate, low inflation, stagnation of growth, and it will be very difficult to get out of that vicious circle as the experience shows in Japan.
Your Excellency, Dr. Fariz, are you concerned about that as well, that there could be a vicious circle if we have this continuing spiral?
Are we trapped in the situation? I'm not yet sure about it. I think there's still room to move, even with the recent reduction of interest rate. I think U.S. still have room to reduce interest rates in case there is a need on further consideration. Lower interest rates, definitely it is going to help out stimulating economy. So I think there is an advantage, but again, we still need to monitor this closely, and we hope that the question of trade war will rectify itself. I think this is a circle, a period where we have this. I mean, 2 years ago we were in Riyadh with His Excellency, and the slogan was, we were asked, what you're going to do? The era of low interest rates has gone. And now, still, from the beginning of the year, we're talking about lowering interest rate. So it's very fast-moving situation. I believe we still have room in the central bank to reduce interest rates further without really harming the economy, and at the same time, probably the situation will show evidences of a bit higher growth and going into stability on monetary policy.
Your Excellency,
Yeah, I
make the
wanted
final
to comment
point.
about the central bank independence. If we continue to undermine central bank independence, we are at risk. Monetary policy has to take its course. The same for fiscal policy. We need better coordination when it comes to these two policies, along with more structural changes that should take place. And of course, we need to continue the move towards more globalization, not less.
Okay, well, thank you very much for your... Oh, Omar, I do want to give you... You can have the last word, because
we are in
keen to get
Kuwait.
it. Yeah,
we are in Kuwait. We've not talked about Kuwait. And I thought we should talk about Kuwait briefly before we wrap up. I just wanted to make one remark. We talk about the global economy, and it is very complex. But in Kuwait, the partnership that we have here with our banks, if you look at the average ROE on banks in Kuwait, it's 11% for 2018. You look at the average ROE for banks in the US, 2018, it's 12%. You look at foreign investors in Kuwaiti banks over the last year. In my bank, it's grown tenfold over the last year. We're 100 bips below the US return on equity. And why is that? It's the quality of earnings and the sustainability of earnings. And I think when foreign investors speak to that and put their money where their mouth is, I think that speaks a lot to our market here in Kuwait and in the Gulf. And I thought we'd end on a positive note.
Absolutely. It's always good to end on a note of optimism. Thank you very much. But just before we do end, let's show you the results of the poll where we ask you what you thought was the most risk to the global economy. Hopefully we can bring it up onto the screen now. I'm hoping we can. From what I did glimpse it earlier, and actually monetary policy, unconventional monetary policy, was around 13% of all of your votes, and the highest was geopolitical risk. Geopolitical tensions, yes. Oh, it's just popped away again. But as you can see there, it was geopolitical tensions which were the highest risk. There we are. Geopolitical tensions, 44%. Rising debt levels, 30%. Trade disputes, 15%. And unconventional monetary policies, 11%. So I certainly feel as though we have really talked through the issues at stake for the global economy today. And I'd really like to thank the panel for the really frank points and discussion today. So thank you very much for joining us. It's been great to have you here on the stage.
Thank you.
Thank you.